Good afternoon, everybody. I was going to talk to you a little bit about renewable asset valuation. I figured I would talk a little bit about Austin Energy first to give you a little bit of context so you might better understand how we look at these projects and how we evaluate them. So first I wanted to just tell you a little bit about Austin Energy and where we are. We are located in the city of Austin in Texas. We solely operate within Travis County. We serve all of the Austin city proper as well as some of the surrounding cities, all within Travis County. And we are a non-opt-in, municipally owned electric utility. We've been locally owned and operated since 1895. We transfer approximately $105 million annually to the city's general fund, which is a large portion of their operating fund. We're the seventh largest public power company in terms of customers by LPPC. They rank people in all kinds of different ways. Austin City Council serves as our utility board, so that makes us a little bit different since we are a municipality. So we are run by people that are elected by the residents of Austin. We are a very environmentally conscious city, and so we have some pretty aggressive environmental goals. We have a 55% renewable goal by 2025. We're looking to be 65% renewable by 2027. That's a brand new goal that was just passed in our most recent generation resource plan, which we just got approved last August. We're looking to reduce our carbon dioxide power plant emissions by 20% below our 2005 levels by 2020. We're looking to create 900 megawatts of energy efficiency and demand response savings by 2025. And we're looking to do all of this with an affordability goal where we have to keep our rates below a 2% annual increase and remain in the lowest 50th percentile for retail rates in Texas. And I apologize, I didn't really mention what a non-opt-in municipality is in ERCOT. A non-opt-in municipality means we are in the competitive wholesale markets, but we are able to have a captive rate base. So we're still vertically integrated. We have the transmission companies, we have the generation company, we have a retail book, and then we have our Queasy. And Austin Energy, our customers really help shape our strategic goals and our overall utility style. They do this through the officials that they elect, and as well through a stakeholder process. So our last generation resource plan, we actually got stakeholders that represented a large group of Austin, people that represented a large business, low income, the environmental community. We brought them all together and we had them help us shape what scenarios they wanted us to run, communicated with them the true costs, and tried to get them all to kind of agree to a generation plan that would work for the city of Austin prior to going to city council for approval. Austin Energy has a very diverse generation portfolio. We have 730 megawatts of older natural gas steam. We have another 300 megawatts of natural gas combined cycle. We have about 470 megawatts of natural gas GTs, 5 megawatts of natural gas DG, which is really some small CHPs that help serve some hospitals. We have 600 megawatts of coal that we will be shutting down soon. We have a goal to have that closed by 2023 and hopefully earlier. We have 1/6 ownership of the South Texas nuclear project, so we have about 400 megawatts of nuclear power. We have 1,253 megawatts of wind under PPA with an additional 200 megawatts under contract that I'll be talking about a little bit later, and I think that Gary alluded to in his presentation. We have 466 megawatts online of solar utility scale with another 170 megawatts under contract, and we're currently evaluating and negotiating another 150 megawatts to go on top of that. This number is actually just a little outdated. We're up to about 51 megawatts of solar DG, which is really rooftop solar in Austin. We have a VOS program where we don't do net metering in Austin, but what we do is we pay you a rate for every solar kW hour that you produce, and we net it against your bill. So we do have some communities in newer neighborhoods going up where they have a zero electric bill on average. We also have a PPA for a 100 megawatt biomass unit that burns waste wood. We entered into that as a hedge against carbon legislation. And then we have a smaller landfill gas biomass unit of about 8.5 megawatts. And so just quickly, here's kind of a map of where all our assets are throughout Texas. So we are kind of spread all over the place. So I want to talk a little bit about a case study, evaluation process, and how we're looking at adding renewables. Since we do have those strong renewable goals that we need to meet, and we do not have tax appetite, we're doing most of that through PPAs right now. So I figured we'd just go through the last one that we've actually completed and signed. I was hoping to go through that solar PPA with you guys today, but it's moving a little bit slower than I would like. So I'm going to talk a little bit about a wind asset in Texas. And so back in October 6th, about a year ago, we issued an RFP for new wind generation. Part of the reason we were looking to do this is we felt that this might be a good time in the market to try to procure wind with the PTC rolling off and people needing to safe harbor in that 2016 period to get the full value of the PTC. We evaluated the projects not only on PPA price, but on net generation revenue, or net revenue, our expectations, dollars per megawatt hour. I'll show you the next slide why we look at it that way. We also wanted to evaluate the projects on the wind profile characteristics, as well as developers' expertise and experience with the PTC rolling off. If we get into a contract and that developer is unable to perform, then we may be looking at entering into higher priced wind power in the future. And then we wanted to conduct some generation output and price distribution analysis using both fundamental and stochastic models. So in ERCOT, I think as Gary alluded to with the volatility, location really matters. So this is a graphic that is published on ERCOT's webpage often that you can go look at. I did not have to go back and find a high peak day to find a graph like this. This was Monday. And it was just early afternoon. And you can see up here in the Panhandle, where you have some very inexpensive wind by PPA price, they were receiving negative prices in the $30, $40, $50 range. You can see out here where you have most of your solar in Texas right now. They were receiving negative prices as well. Unfortunately, we have a 300 megawatt wind PPA up here, and we have 157.5 megawatt solar PPA over here. And then over, if you lived in the Houston area, you were seeing prices around $1,200 to $1,600 per megawatt. This actually persisted. A lot of times we see these blowouts happen for 5 minutes, maybe 10 minutes, maybe 15 minutes. On this particular day, I believe it sat out there for about 4 hours. So you can see if you are evaluating a solar farm or a wind farm and you don't site it in a great location, what you modeled may not come to fruition. So we definitely wanted to take a hard look at where we're going to site this and why. So just looking at the wind project's output profile, I mentioned we already had 1,200 megawatts of wind online. A lot of that is in West Texas, a little bit down on the coast. West Texas has more of an off-peak profile, so we already have a lot of off-peak wind. When you look at the coastal projects, you tend to see a little bit of a better profile in the summertime as well as on-peak hours. So what this looks at is kind of looking at the ratio between off-peak production versus on-peak production for kind of the top 8 or 9 projects here. And you can see that the recommended project really kind of stood out. So it was one of the few coastal wind farms. It's a little bit more difficult to build wind down on the coast. There's some rules that you have to be outside of 25 miles away from military bases and installations, which eats up some of that property, as well as there's a lot of the Eagle Ford down in South Texas, and so there's a little bit of drilling down there as well, so not all that property is available. So this was kind of a first cut in looking at where we were going to identify and really kind of focus on. So we partnered with Ascend. This is the first time we had partnered with somebody else to help evaluate a renewable project. Typically we've done a lot of fundamental analysis using a model called UPlan, but we wanted to look at a little bit more of a distribution around some of the outputs. So this is actually the wind profile. So typically in a fundamental model, we would use the 8760 and model it that way, but that doesn't really give you a lot of wind variability or let you know like what it would look like on a high wind or a low wind year. We do have wind speed data and the power production curve from the manufacturer for the turbine type, so we can go back and we can kind of get that correlation between wind speed and production. And so why this would be important to us is, we have a 65% renewable goal by 2027. We want to understand how this project may fit in if we're not getting averages. It also helps us identify contractually where we might want to put minimum requirements. So if a developer comes to us with an expected output and we want to rely on that expected output to help us meet our renewable goal, we may put contractual terms that they have a minimum requirement, and if they don't meet that minimum requirement, there might be financial penalties, which would help us procure additional wind in maybe a higher price market to help us meet our goal. We also wanted to know kind of the upside of the wind output as well. As Gary mentioned, when wind output seems to be high, prices tend to be a little bit lower. And so you have somebody who's really kind of underselling the output, and you're paying a dollar amount for that output. You may not want a lot more output, because that may mean you're selling it into a wholesale market with lower prices. And so we may look for contractual terms that look for us to have, okay, well, we'll pay the full PPA price up to a certain point, and after a certain point, we're going to start paying you a discounted rate for every megawatt after that. And so this kind of helps us kind of identify where those levels need to be to help protect us. So a little deeper on the evaluation process. It was a little high level before. I mentioned we had 180 proposals. It's not time efficient to run all 180 proposals through models. So we like to generally sort them by region. Regions behave differently in ERCOT. The West is typically much more depressed. Houston typically sits at a much higher price level. The Panhandle is, in my opinion, a terrible place to site any wind right now. After we sort them by region, kind of identify them, if I have 100 proposals out in the Panhandle, for example, and there's one that's maybe as low as $12 and another one at $20, I'm probably not going to look at the $20 one. We're going to focus on a cutoff, take maybe the top 10 or 15 projects in that area. After we've kind of come up with a short list, then the market analysis group will evaluate the regional project short list to provide revenue expectations on $1 per megawatt hour. That helps us kind of hone in on where we want to be and what projects we want to focus on. I mentioned that we also evaluated the projects on wind profile ratio. Some of that should be taken into account in the modeling results. We then shortlisted 3 developers for additional discussion and clarification on proposals. Not everybody submits proposals the same way, so you want to make sure that you're reading it correctly and that everybody's kind of on the same page and nothing has changed since they originally submitted their offers. And then we conducted an additional analysis around the recommended wind farm using the Sims Analytics Pro Power Sim. And we conducted additional scenario analysis around our recommended wind farm using UPlan. I'm calling it recommended wind farm because even though we have signed this contract, for some reason we haven't publicly announced the name yet. So I'm not sure if I should put that in a slide out to the public. We also looked at historical price behavior to further evaluate the potential downside risk as well as view generation curves versus the riskiest price periods in ERCOT. We're much more concerned with downside as we add renewable assets than potential upside. And we compared the forecasted price from UPlan and PowerSim kind of together. It was our first time using PowerSim. We wanted to be very comfortable with the output, so we wanted to kind of dig into the model results to make sure it lined up with what we would expect to see in the market. So for UPlan, this is just an example of some of the types of scenarios that we looked at. Base case, keeping gas prices constant, reducing import interfaces, higher solar penetration, increasing more wind in that area, if it connected to a 138 line as opposed to a 345 line, different wind profiles. Really, we're using more of a fundamental model to run multiple scenarios to almost try to create that probability distribution that you're going to get out of Ascend anyway. Then you've seen the slide a little earlier. I took this from Gary. Then we did some distribution analysis. Ascend helped us with some distribution analysis, and this is where he spoke about the day ahead versus the real time. And so our fundamental models really act more like a day ahead model. And as he mentioned, you typically don't take a lot of your renewable resources into the real time market. Into the day ahead market. You typically take more of them into the real time market. While there's that premium in the day-ahead market, if that wind does not show up, that's typically when you see those big price spikes that we showed earlier down in the south. And so that 13% you might be able to gain could get wiped out very quickly within 1 hour if something happened to the system and the market misforecasted the wind output. So we wanted to dig into this a little deeper and look at why you had that difference in the day ahead and the real time. And we were hoping to see kind of what we saw through the iterations on the simulated behavior. And so what you see here is the green line is your wind generation for this particular node, and the blue is the simulated basis price for that node. And so you can see at periods of time when wind is high, you see a little bit lower prices. When is low, you see the higher prices. And so this helped instill a little bit of confidence in us when using the PowerSim model that we were seeing it simulate in the way that we see the market behave. We also like the backcasting ability to go back and look at the generation reduction and actually go back and say, okay, if we ran this from 2016 forward, how does the simulation compare to the actual wind data? And then when we did the forward price comparison, of course, Ascend is going to move back towards the forward market. In ERCOT, we have a very high-priced August, all years in the forward market, lower other prices. That's why you kind of see these spikes here every summer. That's where the load is the highest in Texas typically, so people feel like that's where there's the most risk. I personally think August is a great month to sell because that's when everybody's geared up and ready to be online, and those shoulder months become a little more risky when wind is serving more of the load and you have a lot more wind production. So what we saw was, UPlan produced a lower price on the on-peak, but Ascend actually produced a lower price on the off-peak. And interesting enough, despite having the higher price in Ascend on the on-peak, we actually saw slightly lower net generation revenue through the Ascend run than we saw through the UPlan run, which was also great because we have felt that the UPlan model has not done a great job of sometimes capturing some of that downside price risk. And then we went back and we looked historically at the price distribution for the nearest node at a similar bus. This project doesn't exist yet, so we had to find kind of a proxy node. We run the scenario analysis to ensure that as we add this new wind that we're not going to run into transmission constraints. That's what we're doing in that fundamental model is we're modeling all the transmission lines and the ratings. And so once we were comfortable that the additional wind would not cause any transmission constraints, we felt comfortable using that nearby node to look at its price activity and see kind of where that price is averaged out with a lot of the prices right there in that $20 to $25 range. But what we were really interested in is very few percentage of negative intervals because that's our largest concern is that we do not want to site our generation in an area where it's going to sit down in those negative prices. We're seeing more and more negative prices in ERCOT. And then we also wanted to compare that generation output to the average hourly price comparison. So what I have here is just kind of average hourly prices by hour, by month. And then this is the average wind profile for this particular resource down on the coast. And what you'll see, and what got us especially excited about this project, is you can see that it seems to peak on its generation in the June, July, August, September timeframe, and it starts to occur kind of later in that afternoon into the evening, where typically we might have more load, and it helps complement our existing wind portfolio as well as our solar portfolio. But you will notice that it seems to peak kind of just a couple hours after where that price peaks. But I believe Gary showed this slide as well. When we look at California and what's going on there with their duck curve and the solar penetration, I personally think that the wind boom in Texas is going to slow down significantly, and it's kind of petering out, but the solar is just getting started in Texas. We're seeing some very low solar prices. I think some of the prices shown earlier are quite a bit higher than we were able to transact with solar. And so the thought was is that if we keep adding solar, where does that volatility occur? And since we have a large renewable goal and we're focusing on solar as well, we're looking for an asset that kind of complemented a solar portfolio as we grow it out. So we looked at where ERCOT shows us moving to in 2031, and you can see that ERCOT has projections for kind of that peak load kind of kicking out, a couple hours, which matches up very nicely with this particular coastal wind farm. And so after doing all of that analysis, that leads us, one last thing we do, and then we always get asked is what's the impact on rates? So we have a power supply adjustment, which is a direct pass-through for us. But before we're going to get any project approved, they want to understand how it's going to impact the customer. So this particular project we have modeled, we think is going to actually be beneficial and have a positive P&L versus wholesale prices. So you can see it actually reduced rates a little bit. This is only half of the story. Credit rating agencies have recently started looking at our PPAs as debt. And so while it may be beneficial on the PSA side, we may have to look at raising base rates in order to generate cash to make sure we have adequate debt service coverage ratio in order to maintain our credit rating. I think our AA, A- credit rating is very important to us. And so once we've gone through all that analysis, that ends up with us bringing a recommendation to our executive team. So we recommended to enter into this 200 megawatt coastal wind farm. We felt the timing would help mitigate the end of the production tax credit. We've talked to developers, and we feel that as the PTC starts to ratchet down, we may see $3 to $5 increase in price for projects outside the Panhandle. The next statement is a little misleading. Turbine technology mature, not expected to see further efficiency gains. We do know that developers are working with larger and larger turbines to try to get some efficiency gains. This is more of a statement relative to what we're seeing going on in solar and in the battery markets, where we're seeing much greater gains and faster drops in prices in those areas than we are in wind. And then the PPA price that we ended up signing for this was the lowest in Austin Energy's wind portfolio. So we're pretty excited about that project. I know I went kind of a little bit fast there, but that's all I had to present, but I'm happy to answer any questions you guys may have. Yes, ma'am.
I'm interested in what you said about the credit agencies looking at your PPAs debt. Are these take and pay or take or pay contracts?
These are take and pay, yeah. So we do structure terms within our contracts to kind of protect ourselves against that, but no, they're typically, as the wind blows, we're going to take the power. We may look at different ways to protect ourselves against the downside through contractual terms and offer curves, but yes, take and pay. Anybody else? Yes, sir.
Just curious, when you mentioned about your transmission analysis throughout the state of Texas, what type of entity would have that kind of knowledge for you to tap into? Would that be ERCOT?
Yes.
Okay.
So ERCOT is the balancing authority for Texas, and so we're able. You download files that have every transmission line, all the ratings, the seasonal ratings on those lines, and then they put out things called the TIPIT, which tell you the upcoming projects that have been approved and where they're going to be sited, and so we'll model those additional lines in future years as well.
Do you have to get into a queue in order to get those studies done through ERCOT? Or?
No, those files are available. You just have to do a lot of work on your own end to turn it into something usable.
Thanks.
Sure. Yes?
Did you limit the amount of projects you took based on your appetite for more wind, or was there only the one project that was attractive?
We limited it in this situation. We had a kind of a growing feeling within the community that it was time to look all solar and to kind of forget about wind. We already have 1,200 megawatts of wind online. That was kind of at a higher level, so we really wanted to try to take advantage of the last bit of that full PTC and find a wind farm that would kind of complement the portfolio. And so we needed to make a compelling case to our executive team, and probably going with more than one project was not going to be achievable. This was actually probably one of the most difficult PPAs we've gotten approval on. I think early on, when you have lower renewable percentages and people don't really see the impact of their bill yet, it's really easy to push things through. And as people start to see prices are dropping in your earlier contracts are at higher prices and there is an impact to their bill, there's a lot more scrutiny on the projects we're doing and how many we do. So we were only looking for about 200 megawatts this time around. Yes, sir.
Do you think you'd be able to maintain competitive rates with the rest of Texas, given your renewable portfolio?
That is certainly our goal. I do think it will be challenging. We have that 65% renewable goal is a hard goal. We actually have a stretch goal to go to 80%. That's what we've been directed to try to figure out. I will, however, say that some of the prices we're now seeing on solar, for example, will make it very difficult for baseload units to stay in Texas. And so some of these projects, I believe, will start to actually have a positive benefit for us as we move forward relative to some of the other generation portfolios out there. There was just an announcement. There's a large 1,800 megawatt coal unit that's going to shut down by the end of this year. And so as we start to see some of those units shut down and maybe some prices kind of appreciate up, since we do these at fixed priced contracts, I think that we'll see some benefit that will probably help keep us competitive. But once again, it really depends on where you site your renewable generation and kind of getting it right. Because you could have like I said, in the Panhandle, you could buy a $12 wind farm that sits at minus $35 for most of the day whenever it's producing. Or you could maybe spend a little more money on a wind farm down on the coast and maybe see positive benefits. So certainly our goal is to stay competitive. Yes, sir.
Given the big price discrepancies in Texas, is there transmission build-out plans to sort of help alleviate some of this?
Texas has been building out transmission probably faster than anybody else, I would imagine. We spent, I think, $5.7 billion in 2016 on transmission projects. That has started to raise the T-costs in Texas, and so now we're getting a little more pushback when new transmission projects are trying to be sited. So transmission is still regulated in Texas, and so it's spread across to all the load, and so people can get that rate of return, so transmission companies are definitely motivated to try to build out. But the market is supposed to work kind of on price signals and where you should site your generation. So there's kind of that back and forth on, do we keep building transmission to try to alleviate this problem, or do we try to help people site their generation closer to load where it may be more beneficial? I don't know if anybody's aware, but ERCOT is actually, I think, the only ISO in North America that does not do marginal line losses. And so there's really not, there's a transmission constraint penalty for being far away, but there's not a line loss penalty for being far away. Yes, sir.
With such a high renewable goal in the future, and with you shutting down your 600 megawatts of coal on a hot summer day when the wind's not blowing, how much of your load can you meet with the non-renewables?
Well, so we peak at about 2,800 megawatts right now. We will be also shutting down that 730 megawatt gas plant by the end of 2021. We do have a very active trading group, I guess, our Queasy, and so I don't think we'd be able to meet our whole load without having any renewables. However, if we're building a lot of solar, that will help as well. But we're trying to move away from looking at serving our load. In ERCOT, you sell all your generation to the market and you buy all your load from the market. And it's been a tough adjustment, when you've looked at things the same way for 100 years to kind of pull that apart. So we're really trying to start to focus on managing our loads separately from our generation, try to optimize our generation and protect our loads. We've set up risk metrics that are designed around load cost limits and net generation revenue targets. Obviously, if you're trying to optimize and you're putting them both in the same time period, you're never going to get the best of either. So I think we would utilize the market on situations when the renewables were not there. Excellent. Well, thank you very much.